Have you ever bought anything online and then started going through your email a week or two later and you realized that you had a discount code that you could have used, but it's now expired? Or you bought something at the store and you get home and a week later you're going through your desk and all of a sudden you find that coupon that you've been saving for months and realize that it's now expired and you can't use it. Well, a lot of times when it comes to tax planning, we find the same situation. There are certain circumstances that we may not be aware of that we could take advantage of until it's too late. And so today we're going to talk about the 2025 tax planning strategies that can help you reduce your taxes, and specifically related after the passing of the One Big Beautiful Bill, or OBBBA, as well as the Secure Act, which was passed in 2019, as well as Secure 2.0 that was passed in 2022. So all of those have changed the landscape of taxes, and where we normally would think that we'd like to make the tax code simpler, with the recent tax law changes, it's actually made it a little bit more complex. And so we wanted to share some perspective from our point of view on different strategies that can help you reduce taxes and plan for your financial future. So starting off, just want to share that although I do have my certified public accountant license, I am not providing your tax advice. We recommend that you consult your own tax advisor. Hammond, Iles Wealth Advisors doesn't provide tax or legal advice. Everyone's situation is different, and as you'll see as we go through some things, there are a number of different nuances that you need to be aware of in doing your taxes and taking advantage of these strategies. So we encourage you to take down this information and to then consult your tax advisor. Now, today's agenda, we're going to talk about the new below-the-line tax deductions. We're also going to talk about the window that I believe has opened to itemized deductions. We're also going to talk about changing our mindset, about thinking about maximum, not minimum, and I'll go into what that means, as well as some year-end strategic gifting. We're at that time of year where we tend to do a little bit more giving, and we want to make sure that we do that strategically. So let's start with the new below-the-line deduction. So what exactly do we mean by below-the-line deductions? Well, below the line just basically means that it's either above or below where we calculate our adjusted gross income, or our AGI. And certainly an advantage of above the line deductions is that it reduces your AGI, which is commonly used for a lot of the phase outs that we see in the tax code, as well as the taxation of your Social Security, and for states like Connecticut that use that to calculate your state income tax, it's also helpful to reduce your AGI for that purpose. But also, these new deductions are below the line, so they will not have an effect on your adjusted gross income. However, they do reduce your taxable income. So it does have some tax benefit to you, but maybe not quite as much as reducing above the line. The nice thing about something that's below the line is that it's not an itemized deduction. It is available to all taxpayers. So whether you itemize or take the full standard deduction, you have the opportunity to participate and take advantage of these below the line deductions. And there are 4 below the line deductions that go into effect for 2025. So you want to be aware of those so that you can make sure that you take advantage of them if they apply to you. There's an additional below the line deduction that doesn't take effect until next year, so you'll just have to wait till next year when we talk about that. So just to give you an idea of what that looks like on your tax form, when we look at the first page of your 1040, you'll see that the adjusted gross income is line 11 on the 2024 form, and that is basically the line. So if there's anything that's deducted above that, it's above the line deduction. And then if it's below that, it's below the line deduction, and it basically reduces your taxable income. So we're looking at these things that will allow you to reduce your taxable income and save you on taxes. Now, one of the most probably talked about new deduction is the new seniors deduction. The new deduction for seniors over the age of 65 is just in a window between 2025 and 2028. So they put these deductions in place for just a few years. And it's a new deduction that is in addition to the already existing age 65 and blind deduction. The deduction is set at $6,000. And so if you are married filing jointly, you each get the $6,000 deduction. And so if you're over the age of 65, congratulations, you're going to have an additional $12,000 deducted from your taxable income for 2025. And why I think this is very important is it allows you to possibly take advantage of that deduction and do some planning rather than just letting the benefit of that go to waste. Now, as with most of the deductions in the tax code, there are phase-out ranges. And so the phase-out is modified adjusted gross income of $75,000 for individual tax filers or $150,000 for joint. And again, as we go through these deductions, you'll see that there are different phase-out ranges. So you can't just look at one phase-out range and say, well, if I'm under that, then all these things apply. And that's one of the reasons why it's important to look at doing either a rough calculation of your taxes ahead of the end of the year or talk to your tax advisor in advance to make sure, are you under or will you have the opportunity to take advantage of it? So just graphically, visually to look at what this looks like, part of the OBBBA Act, or the One Big Beautiful Bill, is that it did raise the standard deduction. So for a single individual, it's now at $15,750. And for a married couple, it's up to $31,500. So now, on top of that, you can add the age 65 deduction. Now, you'll see in this chart that the age 65 deduction that we already have in the tax code that's there on a permanent basis is already on there. And so that's $2,000 for an individual or $1,600 per person for a married couple. And then we have the new seniors deduction in the green bar at the top that goes above that. So to answer some questions that are just coming up in the chat, I just want to mention, so must you be 65 or older during the entire year to take advantage of this senior tax deduction? The answer to that is no. You just have to turn 65 before December 31st of the year to claim it for that year. So you could turn 65 on December 30th and voila, you get the benefit of the deduction for the whole year, even though you're only 65 for a day. As for joint filing, the deduction is $6,000 per person. It also depends on whether each person is over the age of 65. So it's a great question. So if only one spouse is over age 65 and the other spouse is, say, 62, you're only going to get a deduction for $6,000 for the one spouse that's over age 65. To get the full $12,000, both spouses need to be over the age of 65. So great questions coming up so far. Now, another deduction that may or may not apply to you is that there's no tax on tips, or at least part of the tips, and still looking to see on exactly how this is going to be reported to the IRS and how it's calculated. My guess is there'll probably be some changes to the W-2 form coming down the pike. But for now, what we know is that there can be a deduction up to $25,000 for all filers. And then the deduction starts to phase out once you cross over, again, an adjusted gross income over a certain level. And there are specific requirements to take advantage of this. I can't start asking for tips when you leave my office if you come in to meet with me. Unfortunately, number 3 there is I'm in one of those specified service trades that is excluded from this. Also, it has to be an occupation that traditionally and customarily receives tips. So whether that is a wait staff at a restaurant or something that normally you would expect to give a tip, they would be the individuals that could take this deduction. Also, tips must be on a voluntary basis. So it can't be a tip that's just mandatory added on to your bill or invoice. It has to be something that you give voluntarily. And there's going to be some more regulations that come out about this to really define kind of what those roles are that are traditionally, customarily, and some additional tips on how that is recorded and reported to the IRS so that they can make sure that you're not just arbitrarily claiming tips that didn't exist. So for those that work in a profession, whether that's you, a child, or a grandchild, you want to make sure that they're aware that they have the opportunity to take this deduction. There's also no tax on overtime deduction that's been added. And again, it's for the 2025 year through 2028. And there is a deduction for up to $12,500 for single filers and $25,000 for joint filers. Again, it gets reduced if your modified adjusted gross income is above either $150,000 or $300,000. And the deduction only applies to your overtime. And this is where the math gets a little bit tricky and how that gets reported to the IRS. So if a worker earns $20 a month, and so they make time and a half when they work overtime, so they make $30 for that overtime hour, it's only that $10 increase above their normal pay that gets to be deducted. So it's interesting that individuals are going to have to track how many hours of overtime they're working, and they'll have to do the math to see exactly what the difference is between their overtime rate is and their standard normal hourly rate is. So we'll have to see how that, again, may be reported on the W-2 at some point so that we don't have to track that and do the math. I'm sure the IRS, again, will want to make sure that they verify it in some form or fashion. One thing that I do want to point out, because people say, oh, there's no tax on overtime. Well, and there's no tax on tips. Well, that's true from an income tax situation. However, the deductibility of tips or overtime income are still subject to payroll taxes and are included in your adjusted gross income. So it also could be potentially taxable at the state income tax level. So this deduction for tips and overtime, yes, it's a nice deduction and it's a benefit for those that work in those industries that can benefit from that, but it's not completely tax-free as some news media may kind of promote and make it sound like. Now, the fourth deduction that's available is an auto loan deduction. So now your interest on an auto loan between 2025 and 2028 is now tax deductible as a below-the-line deduction. So you don't have to itemize again. So you can deduct up to $10,000 of a new passenger vehicle. Again, it's new, and it's loan interest on new loans taken out after December 31st of 2024. So I'm sorry, if you bought your car last year in 2024, you just can't meet that threshold. But if you happen to buy a car earlier this year or plan to buy one before the end of the year, you will have the benefit. Now, there are some additional qualifications. The car must be brand new, and the final assembly has to occur here in the U.S., and it has to be for personal use. So it can't be a business vehicle. It's for personal use only. And there are deduction phase outs again. a little bit lower than the previous deduction phase out. So again, that's why you have to pay attention. But if you are buying a car, if you can get a reasonable interest rate, this might be a reason to potentially look at financing it. But certainly for those that need to finance, there's a little bit of an additional tax benefit to those as long as they're buying a U.S. assembled car. So our second item is the window to itemize deductions. It was very interesting. After the passing of the first of the Tax Cuts and Jobs Act, many people moved away from itemizing. And here's an example of a couple, Mike and Barbara. They're both age 62. They're both still working. They have no debt. They annually support their church and other nonprofits. And so one of the things in looking at their deductions is when the Tax Cut and Jobs Act passed back in 2017, the standard deduction was greatly increased. It was for a married couple filing jointly, it got bumped up to $30,000. So for most individuals, that amount was well above what they could itemize for tax deductions, especially also because there was a cap or a ceiling put on SALT deductions, or what we call state and local taxes, and I'll get into that in just a minute. But one of the things that the One Big Beautiful Bill did is it increased the standard deduction. So for 2025, you now get an extra $1,500 for married filing jointly, an extra $750 for individual filers. But keep in mind, this is just the standard deduction. So thinking back to that chart, if you're over the age of 65 or have a spouse over the age of 65, you get those extra deductions on top of this standard deduction amount. But what I see here as an opportunity, and why I say the window is opening for individuals, is that there are possibly more opportunities to itemize. It's interesting, after the passing of that tax bill back in 2017, as I said, many people moved away from itemizing. For the tax year 2022, only 1 out of 10 people itemize on their tax return. The other 90% used the standard deduction or were over the age of 65 and had the standard deduction plus either the over 65 and blind deduction. I don't like to call it elderly. I don't know why they call it elderly deduction. Nobody wants to be referred to as elderly. We're all young and spry. So one of the reasons why the window I see is opening for more people to itemize is that the SALT cap has increased. So that state and local tax deduction for years 2025. Now this one, again, a little bit different going to 2029. There is an increase. So it was set at a cap of $10,000, and that has been temporarily increased up to $40,000 for single, head of household, or married filing jointly. So there's no higher cap for your filing status. It's a one cap fits all. And so in the past, if you lived in a town where your property taxes were over $10,000, or between your property tax and what you pay in Connecticut or any other state tax, you're over that $10,000, you saw your deductibility of those taxes limited to that $10,000 cap. And that was just a contributor to more people wanting to use the standard deduction because it ended up being a larger offset to their taxable income. But now this year, it's now $40,000, and for the next few years, it'll go up by 1% every year. And then in 2030, assuming Congress doesn't change the tax laws again, it will revert back to $10,000 in 2030. So this is the window. This is your window between 2025 and 2029 to potentially take advantage of this higher cap. There also is a phase down if you're up in a higher income bracket. So again, to be aware of that. And for those that own their own business, the state level pass-through entity taxes still is deductible as your kind of state tax under the SALT cap. So here is a strategy that I wanted to bring your attention to. And again, it's important that you know about this before the end of the year so that you can take advantage of it. Now, you could certainly plan to do it next year, but I wanted to show you an example for this couple. As I mentioned, they are still working and they own their own home. So they're paying roughly $7,000 semi-annually for their property tax here in Connecticut. So they're paying $14,000 a year. And they also are charitable and they donate roughly around $10,000 a year. Now, if we look at just those two items, now state tax would come on top of this, but just looking at these two items, their total itemized deduction for 2025 would be $24,000. The property tax plus the charitable donations. Now, as I mentioned, the married filing jointly standard deduction is $31,500 for 2025. So in this example, if they did nothing, if they just did what they normally did, they would certainly file and use the standard deduction. Why not? It's higher than what they would itemize. However, there is a planning opportunity here to do what we call bunching, taking deductions and bunching it into a single tax year. So how can we go about doing that for this couple, just looking at these two items? Well, the first is normally that first payment of the property tax is usually in January of the year. So we could take that January of 2026 tax payment and we could slide it back into 2025. Pay it on December 30th, the 31st, as long as it is deposited before the end of the year or submitted for deposit, then we know that we can claim it as property tax paid in 2025. Now, also with their charitable donations, we can also bunch them. And that can actually be much more substantial than just shifting 1 year. We can actually shift 2 years, 3 years, or even more years into a single year by shifting them all back by using an investment account called a donor advised fund. So in this example, we took 3 years worth of charitable donations, or $30,000, and we consolidated it into 2025 and put it into a donor advised fund. I'll go into a little bit about exactly what that account is in just a minute, but it allows us to deduct all $30,000 in the year that was added to the donor advised fund. So now if we look again at their tax situation for 2025, we now have total itemized deductions of $51,000 because we have the 3 property tax payments plus the 3 years worth of charitable donations that we made to the donor advised fund. So now when we're looking at their taxes, that window has opened for them and now they're able to deduct an itemized $51,000 this year and take full advantage of their charitable giving. Because in the past, their charitable giving made no tax benefit to them. They gave a little bit every year, and as a result of that, they were under the standard deduction, so there was no benefit for their giving. Now we're taking advantage of their giving by bunching it together into a single year. Now, the interesting thing about this is you may be looking at this chart and saying, well, Greg, now they don't have anything in 2026 except a single property tax payment. Well, that's the beauty of this plan is even though they're still going to give charitable donations to the organizations they care about out of the donor advised fund in 2026, when we come over to 2026, now they flip back to the standard deduction. So even though they're not making charitable donations into the donor advised fund, although they could, now they can take full advantage of the standard deduction in years when they're not spending as much for property tax or for charity. So this is a way to maximize the deductibility and itemize in a single year and then use the standard deduction in subsequent years. And you can plan this out over a longer time frame than just 3 years. You could front load your donor advised fund for the window that's open between 2025 and 2028, and then use the standard deduction after the SALT cap goes away. But this is an opportunity to take advantage of bunching itemized deductions. Now, just to give you a quick overview on how a donor advised fund works. This couple that we were talking about, Mike and Barbara, they are donating $10,000 per year. So again, we bunched that together. They created the Jones Amazing Impact Fund. It's kind of one of the fun things you get to do when you create a donor advised fund is you get to name it. So you can come up with whatever name that you'd like to have, which just makes it a little bit more enjoyable, in my opinion. So they gave $10,000 a year. And so we're bunching it again together. So we're doing $30,000 as a donation. Now that can come from cash, and many people, that's kind of the first thing that comes to mind. However, and I'll talk a little bit when we talk about strategic gifting, a better option would be appreciated investments. And we'll go into kind of the tax reason behind that, but you get two benefits with just one gift. So you gift the money into the donor advised fund, depending on where we set up the fund or where you set up the fund. You may have control over the investments, or you may not. You may have just an investment pool that you can elect into. But then when you want to make a donation, you submit a grant request to the donor advised fund, and then they send the donation out on your behalf to the organization that you care about. So there are a number of benefits. One is that it allows you to claim that larger charitable deduction in a single tax year. It allows you to use kind of that standard deduction in the subsequent years like we looked at. And it's nice because you only have one donation letter. And this is helpful if you have multiple organizations that you give to throughout the year. You don't have to track down all of the donation letters, because really the only one that counts is the donation going into the donor advised fund. So you just need that one donation letter. So tax reporting is a lot easier. And because if you're using appreciated investments, one of the little sneak peek is that you can avoid capital gains tax. Now also, you get to control the investing in the donor advised fund, and a balance can stay in a donor advised fund for a period of time. You're not required to pay it out. So that $30,000, you don't necessarily have to spend that or donate it out to charities in year 2 and 3. You could allow it to stay in there and just be invested and grow. If you wanted to take advantage of that window, you could make additional donations into the donor advised fund during that 2025 to 2028 window to take advantage of the itemization while the SALT tax cap is higher, and just allow that balance to build up. Some clients like to use this while they're working to put money aside, or if there is a large transaction in their life, whether it's a bonus from work or you sell your company, it's an opportunity to carve off some of that money and front load it into your donor advised fund. So then later in retirement, you can use that for your charitable giving, and it doesn't impact your monthly cash flow. Also, you can pay out to multiple organizations depending on where you host or custody the donor advised fund. They may have a check minimum. For example, Charles Schwab typically has a $500 check minimum for their donor advised fund, but different organizations will have a minimum. I see that there is one question about charitable contributions can be distributions from a traditional IRA considering a large qualified charitable distribution. I'm going to get to qualified charitable distributions a little bit later, Joe, but one of the things with a qualified charitable distribution is we're looking at a donor-advised fund. Is a donor-advised fund for QCD purposes does not count as a public charity. So you can't make a qualified charitable donation out of your IRA into the donor-advised fund. It has to come from outside of your retirement accounts to go into the donor-advised fund. But we'll talk a little bit about that, just tipping my hat a little bit of some of the things we're going to talk about a little bit later. Now, one of the other reasons why you may want to front load your charitable giving in 2025, and this is again that coupon that you might find that is expired next year, is the One Big Beautiful Bill implemented a floor on charitable giving that will go into effect in 2026. So next year, deductible charitable donations must exceed 0.5% of your adjusted gross income before becoming deductible. Charitable deductions are still subject to the same AGI limits, 60% for cash and 30% for adjusted gross income. So what that relates to is if I make $100,000 as my adjusted gross income, I could give up to $60,000 out to charity organizations and deduct that in that single year, or up to $30,000 of appreciated investments or other non-cash contributions. If I gave more than that away, I still get to deduct it, but it carries forward into a future year. So these limits on charitable deductions still apply, and those are the same as before. And this floor of the 0.5% is applied before they calculate the percentages of adjusted gross income. Now, the interesting thing is that the amount that's subtracted from the floor does not carry forward unless the total contributions or donations exceed that AGI limitation. So let me give you an example. Again, if I have Sue has an AGI of $100,000 and she donates $1,000 to a public charity. So for her 0.5% of $100,000 is $500. So if she's going to itemize, she only is able to deduct $500 of that charitable gift. Now, there is a new cash below-the-line deduction for charitable giving that kicks in 2026 that would benefit her in this example. But for 2025, if we're looking ahead at 2026, the charitable giving would be limited. And again, if she gives more than $1,000, gives a lot more than that, the only time that $500 would carry forward to the next tax year is if she gave more than the 30% of non-cash investments or over 60% of her AGI in cash investments. So next, I want to change your mind. Most of us, when we think of taxes, we say we don't want to pay any tax. I don't want to pay any tax. I want to minimize my taxes as much as possible. But I want to hopefully convince you today that you want to turn that around and look at how you can maximize your tax according to some parameters today to save you money in the future. So when we look back at the Secure Act of 2019, one of the main reasons why I'm encouraging you to think about maximizing rather than minimizing is a change that was made in the original Secure Act that basically eliminates stretch IRAs. Prior to 2020, so if you had a relative that passed away in 2019 or earlier, everyone who is a beneficiary could stretch their inherited IRA. So you could stretch out the tax deferral of that IRA over your lifetime, taking out potentially a minimum distribution or whenever you want to take a distribution out of that, but you could stretch it out for a very long time, allowing it to grow tax deferred in the meantime. However, Congress passed the Secure Act and they eliminated the stretch IRA for most beneficiaries. So for most individuals, that has gone away. So now, effective after January 1st of 2020, the stretch IRA was replaced with a 10-year rule. So most non-spouse beneficiaries, except for what they call eligible designated beneficiaries, must take distributions for the entire inherited IRA balance within 10 years of inheriting the account. So for example, if my mother passes away and she leaves me $1 million IRA, nice problem to have, but for me, that means that myself and my sister, we have to take that $1 million out of the IRA and pay tax on it within 10 years of inheriting it. Now, hopefully, she's living long enough that I'm going to be in the peak of my earning years when she may ultimately pass away. And the last thing that I want to do is then take that $1 million and my sister and I have to claim an additional $100,000 a year plus the growth on it every year to draw it out within the 10-year time frame. So this can be an extremely expensive way to pass on wealth to the next generation. And the 10-year rule applies to all retirement accounts, including Roth IRAs. So even though there's no tax consequences of withdrawing from a Roth IRA, it still has to be emptied out within 10 years. And that was really a benefit for stretch IRAs. If you inherited a Roth IRA, you could stretch that out for tax-free income for your entire lifetime. But that no longer applies. Now retirement accounts, they have to come out within 10 years. Now there are always some exceptions to the rule, and the eligible designated beneficiaries are the spouse of the deceased. If any of the beneficiaries are chronically ill, if they're disabled, if the beneficiaries are not more than 10 years younger than the deceased account owner. So for example, you may have a couple that are partners but are not legally married. In this case, they may not be more than 10 years apart, and so that partner may get the benefit of a stretch, even though they're not legally a spouse. It may also apply if you inherit a retirement account from a sibling, brother, sister, that is less than 10 years older or younger than you are. So then the other is a minor child. So if you do have a biological or adopted child that is under the age of 21 that inherits an IRA, they will have the ability to stretch that out until they reach 21. And then at that point, it flips to the 10-year rule, and they'll have to take that out in the following 10 years before they reach the age of 31. So what we're going to see is a lot more tax consequences from retirement accounts. So how can we plan for them? And it's not only for your beneficiaries. I think it's also important to start thinking about your own retirement income when you start thinking about your IRA, your 401k, your 403b, or any type of retirement account other than a Roth IRA, which comes out tax-free. Anything that is pre-tax that's taxable, as it grows and compounds, the original start of those retirement accounts, we were all under the impression that if we sock money away, it's going to grow tax deferred and then potentially come out when we're retired in a lower tax bracket. However, my experience is most people want to maintain the standard of living in retirement, and their taxable income typically stays around the same amount, although it may vary based on the type of assets that are tapping into or the type of income that they're receiving in retirement. But as that retirement account continues to grow, it's basically a ticking time bomb of taxes, whether it's for you during your lifetime or for your beneficiaries. Someone's going to have to pay the tax, so it may be an opportunity as we just talk about those opportunities to have additional deductions, whether it's the age 65 or older or some of the other deductions. If we bunch or increase our itemized deductions, it may be an opportunity to turn to the other side and increase our income to maximize the tax benefit. Now, one of the other things I want to bring to your attention, I want you to make aware of, if you're approaching retirement or just early into retirement, there's also what we call the income valley. So in this chart from Fidelity, talking about a couple that have their salaries coming in and they retired at their full retirement age for Social Security at age 67. So they have their income coming along from their salaries, then all of a sudden they drop down to what they're receiving from Social Security. And now they make up that difference of whatever they want to have, either from savings that they have or potentially after-tax investments. And so from a tax point of view, it can be, you might be saying, well, hey, this is wonderful. My tax rate just dropped because now what I'm showing as taxable income is extremely low. And then a few years later, you may start tapping your retirement accounts. And then for this couple that were born after 1960, their required minimum distributions kick in at age 75. For most individuals born before 1960, your required minimum distributions will kick in at age 73. So then all of that money that you've been socking away in the retirement account that's growing by leaps and bounds or growing is now being required to be drawn out as income whether you want it or not. So how can we start to plan and take advantage of that income valley to shift some of that taxable income from the future over into a tax-free situation to save you taxes in the future? And one of the ways to do that is by taking a look at making some conversions. And now, just as a brief overview, again, the Secure Act 2.0 of 2022 changed the retirement age for required minimum distributions. It got bumped up from 72 up to 73 for anyone born between 1951 and 1959. And then, as I mentioned, for those that are born after 1960, your required minimum distribution age will be age 75. So I hopefully planted the seed as to why we may want to look at maximizing versus minimum. As an analogy for that, I was thinking about when you pull up to the gas station, you're running on fumes or your tank is low and you're wanting to fill up, but then all of a sudden somebody runs out and says, congratulations, you can get 50% off of your gas. Now, are you going to say, that's great, I can save the money on my gas, I'm only going to fill my tank up for what I need for the next few days? Or are you going to fill it all the way up to take advantage of that? Potentially call your spouse and say, hey, bring the other car over, take out the gas can out of the back, and maximize the amount of gas that you could buy at the discounted rate. My guess is if I asked you to raise your hand, you'd say yes. I'm going to maximize my discount and get as much gas as I can into my vehicles to take advantage of that discount. I see some of you are raising your virtual hands. Absolutely. Take advantage of that discount. So when we think about income taxes, it's very interesting. Here we are, we're at a point in time where when we look historically at the top tax rate, we are at a very low tax rate for taxes, but yet we don't take advantage of that. It's interesting when we look back at this chart, it's really amazing. 1944 and 1945, the top tax rate was as high as 94% back in those years. And was over 90% for several years in the 1950s. So now we're down at 37% as the maximum tax rate. So what can we do to take advantage of our historically low tax rates? So especially if you're down in the 10, 12, or 22% tax bracket, you may want to take a look at, do I have room to potentially convert some of that taxable money over to a Roth IRA to be able to take advantage of that? Even if you go above that, you could potentially have some really substantial long-term savings, and I'll go over an example of that in just a minute. But when we're thinking of filling up those tax brackets, we don't want to think of what's the minimum. How can we shrink down our taxable income into that 10% or 12% bucket? It's how can we fill those up? Take advantage of it. Just like the coupon or the discount at the gas station, we want to take full advantage of those low rates while they're available, especially if this is the year where you take advantage of that bunching of deductions. We want to take full advantage of that. Yes, is it nice if it completely zeroes out your tax liability? Yes, but you're giving up the opportunity to take some of that money out of a taxable account, shift it over to a Roth account where the future growth of that will grow tax deferred and ultimately come out tax free. So rather than thinking about the minimum, only taking what is required of you if you're over the age to have a required minimum distribution, let's think about maximum. How do we maximize those lower tax brackets and not let them go to waste? Just like the coupon that we find weeks after it expires, let's make sure that we're taking full advantage of this every year so that we can make sure that we're reducing taxes in the future. Now, keep in mind on this table that I created, when it talks about the first $23,850 for a married couple and then the next $73,000, this is taxable income. So this is your adjusted gross income minus either your itemized deductions or your standard deduction. So really when you're looking at $23,000, that's not roughly $24,000 of income overall. That's really $24,000 plus the $31,500. So that's really upwards of almost $55,000 that then you're looking at adding another 73 above that potentially and still staying within the 12% tax bracket. Now, I do want to put a pause here and again want to highlight that it's important to be aware of all of those different phase outs that we talked about when we were talking about deductions. So we do want to fill up the buckets, but we also want to be aware of other ripple effects that happen because there are other taxation levels that we need to be aware of for Social Security. We also need to be aware of if you're over the age of 65. We want to be aware of impact on our Medicare premiums. So we also want to be looking at these other factors. So it's not something that we just easily calculate and say, well, we're done by just calculating this number. We want to look at all the ripple effects before really jumping in. So I want to share with you an example. Here's Michelle and Arthur. Both are age 73, and they realize that they're not going to need all of their retirement savings, that they want to leave a legacy for their son. So through talking with their tax advisor, Arthur converts $200,000 of his IRA. Now, in most cases, I would highly recommend, if you're able to pay the tax outside of the Roth IRA so that you get the maximum amount going into the Roth IRA. But in this case, they didn't have the funds outside of it available, so they just had the taxes withheld at the time that he made the conversion. And for simplicity's sake, we're going to assume that their federal tax plus their state income tax equals 25%. So on $200,000, they'll pay $50,000 in taxes. So they'll start that Roth IRA with $150,000. So let's take a look at an example. And in addition to that 25% tax rate. We're also going to make the assumption that we're just using a very conservative 6% annual growth rate for all of the individuals involved in our illustration, and that the required minimum distributions for the ease of calculations are taken out on January 1st of every year. So try to make it as easy as possible. So we're going to compare the two scenarios. So you have $200,000 that's now in the traditional IRA. It's pre-tax, so it will be taxable to someone. And then we also have the other side by side, of what does it look like if he converted that $200,000 IRA into a Roth IRA, paid the $50,000 in tax, so now he has $150,000 working for him inside the Roth IRA. Now, because he's 73, it's that magic age, he has to take a required minimum distribution. So he starts taking that out, and unfortunately, Arthur had some health issues and passed away just 6 years later. So over that 6-year time frame, he withdrew $39,118 after tax that he took home, and that left his traditional IRA. It was growing by that 6%. So the amount he's taking out each year was less than the 6%, so it was growing over time. So when he passes away, that traditional IRA is now worth $220,000, and the Roth IRA, because it's a Roth and comes out tax-free, after 5 years and 59.5, he just let it grow, and it's now up to $212,000 on an after-tax basis. So now his wife inherits the account. Michelle receives those IRAs, converts it over into her own IRA in her name as a spouse. And so she, because she's over 73 as well, picks up just where Arthur left off in doing required minimum distributions. Now, at that point, she lives for 9 years beyond that. So then she passes away after taking roughly $86,000 out. And at her death, now she has an IRA that's worth just a little bit less, around $218,000, because as you get older, those minimum distributions get bigger with a lower life expectancy figure in the calculation method. But again, if it was in the Roth IRA, she's not required to take anything out of that. And so it just continues to grow at that 6% assumed rate over the time frame. And so when she passes away, the Roth IRA would be worth an estimated $359,000. So now let's take a look at her son, Arthur Jr. He now inherits the traditional IRA and the Roth IRA. Now, because of the Secure Act, he's now subject to the 10-year rule as a non-spouse beneficiary. So he has to take all of the money out of either of those accounts within 10 years. Now, for a traditional IRA, he didn't want to take all $218,000 out in a single year or even split it over a few years, so he decided to even it out and take it out over all 10 years. So he, after taxes and letting it grow, he ended up in his pocket $215,871. So at the end of 10 years, he has nothing left in the IRA, and he has those funds that he's received over that 10-year time frame. Now, the Roth IRA, on the other hand, because it comes out of the Roth IRA tax-free, there's no incentive to take it out during the 10-year time frame. So if he doesn't need it, for example, he may take it out and then make a contribution to his own Roth IRA. But if he doesn't need it for that purpose, he can just let it grow for the full 10 years. And so that $359,000 would have grown to $643,000 in change. And that all comes out after tax, tax-free. So you can see that just over a period of time, the difference between having a traditional IRA and a Roth IRA can make a substantial impact on leaving a legacy to your beneficiaries. And all in the meantime, you're not giving up access to those funds. So if you needed to tap into the Roth IRA during your lifetime, you can. There is a rule with a 5-year rule with a Roth IRA that you need to have a Roth at least 5 years in order for you to withdraw the growth of the earnings out. But whatever you convert in can come out to you at any age without any taxes or penalty. And once you get past that 5-year mark from the original conversion or contribution, then you are home free on taking tax-free distributions. It's one of the reasons why we recommend, even if you want to look at just a small conversion, start with a small amount, convert it over, and start that 5-year clock running. The interesting thing is, even if you converted today, you would be considered as making that conversion on January 1st of 2025. So from that standpoint, your 5-year clock starts at the beginning of this year, even though you may convert towards the end of the year. So there is a benefit to even just starting with a small amount. But just a few things to keep in mind that when you are considering a conversion is that you can do part or all of an IRA. You don't have to do the whole IRA. It's up to you as to how much you want to convert. And this is where, working with your tax advisor, you can see how much room do I have to fill up those buckets. Now, if you're under the age of 59 and a half, you can still do conversions. And the nice thing is that on a conversion, that 10% early withdrawal penalty does not apply to an IRA. You're able to convert without the penalty. But it is not waived on the amounts taken from a traditional IRA to pay income taxes. So in my example of Arthur and Michelle, where he used some of that money converted to pay the tax on the conversion, if they were under the age of 59 and a half, we wouldn't do that, because not only would they pay the income tax, but there would also be the 10% early withdrawal penalty on top of the conversion amount. Or at least not the conversion amount, but the amount that they withheld for tax. Now, also, the conversion has to be completed within a calendar year. So unlike a Roth IRA or a traditional IRA contribution that you have up until April 15th of the year following the year that you want to make the contribution for, a conversion can only happen within the calendar year. One of the other things that you also want to make sure that you're aware of is that you also, if you're taking required minimum distributions, that minimum distribution has to happen before you can make a conversion. So if you typically wait until December to take your required minimum distribution, then you're going to have a smaller window to make a conversion. So you may want to move the required minimum distribution up earlier in the year if you want to look at making a conversion. So as I mentioned earlier, it's most effective if you can pay the income taxes outside of the Roth IRA. That way, more of it goes into the tax-free account to grow. And again, we recommend consulting with your tax advisor so you have no surprises when it comes up to tax time. Now, one of the questions that was raised earlier by Joe was qualified charitable distributions. So for those of you that are over the age of 70 and a half, you can make a charitable donation out of your retirement account, an IRA that is, a 401k, 403b, or an employer retirement account. You can't do this from. It's only from an IRA. But you can give up to $108,000 in 2025 directly from an IRA to a public 501c3 charity. And again, that does not include a donor advised fund. And that annual limit of $108,000, that's adjusted for inflation, so that will go up every year. Now, you don't have to do a full $108,000, but you can gift it away. Now, the great thing about using a qualified charitable distribution is that you're using pre-tax dollars to make a donation to charity, and it's not reported as taxable income when it comes out. Now, you don't get the charitable deduction if you're trying to itemize or bunch, but it does count towards your required minimum distribution if you're over the age of requiring a distribution. So you get a twofer there. You get a tax-free distribution out to charity, and it counts towards your minimum distribution. Now, the nice thing about it is you can get potentially a triple tax benefit from a qualified charitable distribution. Because it's not reported as income, it actually lowers your adjusted gross income. It's not reported as income, so that's going to avoid federal tax. If you live in a state that taxes based on your adjusted gross income, it'll eliminate the state tax on that. And if you live in a municipality that charges a city or state, a local tax, that avoids that as well. So a qualified charitable, let me say that one more time, a qualified charitable distribution, or a QCD, can be a very tax efficient way of using those pre-tax dollars to make donations to charity. And effective in 2023, after Secure Act 2.0, you now can make a once in a lifetime donation of up to $50,000 to what's called a split interest entity. So if you're interested in making a charitable impact while still getting an income during your lifetime, you may think about this as a way of either creating a charitable remainder trust or opening a charitable gift annuity with a nonprofit organization. Both of those can pay you an income during your lifetime, and then the principal upon your death goes to the charity at that point. So there is a one-time deal that you can do something a little bit different with that. So now trying to wrap up, and I know that we're getting a little bit over our hour, but I want to make sure that you're aware of these tax benefits so you can take full advantage of it. It's strategic gifting. I talked a little bit about this when I talked about the donor advised fund. We'll take a look at Sue and Matt. They're ages 40 and 37. Both are working. They started investing right after college. They're diligent savers, and they annually support their alma maters as well as other nonprofits. But they usually donate using cash or a credit card. That's usually the first thing that goes through all of our minds. Someone asks me for a donation, you look in your wallet for cash, or hey, do you take Venmo or a credit card? How can I pay it? But really, when we look at our overall net worth, cash is just a small sliver of what we actually own. So how can we be a little bit more tax strategic in making that gift? And it's through donating an appreciated investment, where you give once and you save twice. So here's a quick example that we did for Sue and Matt. They purchased an exchange traded fund, or an ETF, back in 2015. They invested a total of $20,000 in that exchange traded fund over the years. And now, as of the end of September, it's now valued at $45,000. Now, if Sue and Matt wanted to use that money for anything, whether it's making a donation to charity or making improvements to the house or anything at all, they would need to sell that investment, and they would recognize a capital gain. So a capital gain is the difference between their cost basis, or what they originally paid for it, plus any reinvested dividends, and what they sell it for. So in this example, the unrealized capital gain is $25,000. So if they sold this investment, they would pay capital gains tax on that $25,000. Now, if they wanted to make a substantial gift, or even over periods of time, they could donate shares of this exchange traded fund to the charity. Now, when they do that, as long as they've owned the investment for more than 1 year, they get a tax deduction for the full market value of the investment. So if they wanted to make a big gift, let's say they gave all of this exchange trade fund, they would get a charitable deduction for the full $45,000, even though they only paid $20,000 for it. Now, the additional capital savings is that they're not going to pay capital gains tax. The nonprofit organization, when they sell the investment, they won't pay tax on the $25,000, so they'll get a tax benefit of the full $45,000 and not have to pay tax on the $25,000. Now, if they do invest into a donor advised fund or into some other charitable fund, the other advantage is, especially if you have a large, like single stock or a very large position in an investment, it also allows you to sell it and diversify that investment within the charitable fund. Now, one of the other things, because sometimes some people say, well, I don't really want to give that stock or that investment away. My dad gave that to me, or I inherited it from a family member. However, in that example, if we were going to donate the full $45,000, what I would suggest doing is donate the stock or the investment to the charity and then use the cash that you would have donated to buy the investment back if you really, really want to have that same investment. What that does is it reestablishes your cost basis, and now the cost basis is now set at the 45,000 or whatever you're investing in, rather than the lower cost basis of when you originally purchased it or inherited the investment. So donating appreciated investment is a great way to make an impact on an organization where you give once and save twice. So today we talked a little bit about the below-the-line deductions. You can take advantage of those whether you itemize or use a standard deduction. So everybody, if you're over the age of 65, have tips, have overtime, or purchase a car this year, you'll have an additional tax savings. There's also the opportunity to itemize. There's this window with the higher SALT cap that you can now itemize and bunch deductions together to take advantage of that, to lower your taxable income, or potentially be able to convert some of that taxable assets over to a Roth IRA without increasing your tax liability. So make sure that you're thinking maximum. How do I maximize the benefit and the lower capital or the tax rates that we have today? Because there's no guarantee, even though they were made permanent at this point, odds are there will be a new tax act at some point in the future. With a national debt of over $38 trillion, I don't see how we may not see a tax increase at some point in time. So think about maximizing the benefit of lower tax rates now rather than minimizing taxes. We also talked about strategic gifting. Now, if you're still wondering about how these strategies might apply to you or many of the other strategies that could be implemented that we didn't talk about today, I encourage you to reach out to our office, whether you're a client of Hammond Iles Wealth Advisors or just want to have a free conversation with a financial coach. There's no minimum investment at our firm. We believe that everyone starts somewhere. So whether you're a new investor or just getting started, consider giving us a call to help you along the way. We continue to believe in education. An educated client is our best client, and so we offer these financial power hours on a monthly basis, as well as our weekly Financial Friday 60-second financial tips. And you'll find all of those recordings on our YouTube channel. So if you'd like to revisit this tax program or any of our other financial power hours, you'll find them there. Make sure that you follow, connect, or like us on social media so that you'll make sure you're aware of what we do post and share. Our resources on Hammond Iles website are there for you as well. Some of the common and more downloaded items are our family inventory workbook, a central place where you can gather all your financial information for your beneficiaries to find one place to get all your information. Or if you're unfortunately have someone pass away in your family, we have a download of 20 things to do after a loved one passes away. So we have some valuable resources there. I encourage you to check them out on our website at hiwealth.com. To sign up for that free conversation, you can scan the QR code here on the screen, or you can just go to hiwealth.com and click on the button in the top right corner. So I thank you very much for taking time to spend with me today. Here's our contact information of our offices in Connecticut, Vermont, Virginia. We have clients in over 30 states around the country, and we'd love to be able to work with you if we're not currently working with you or your family members currently. So with that, thank you for staying beyond our 60 minutes. Hope it was worthwhile for you. We appreciate it. And now we'll wrap up for the day and just take some questions.